Hello, and welcome back to another financial accounting video. My name is Lasidi, and I love accounting because it helps me to make better decisions. I hope to have enough saved by the age of 40 to start my life of full-time service. To do so, I need to invest wisely, and a first step in prudent investing is examining a company's financial performance as reported in its financial statements. In this video, I will provide an overview of the basic financial statements, including an illustration of how financial statements can be used to make informed decisions. The objective of financial reporting is to provide useful information that helps investors evaluate the company's performance and risk. A primary way that financial accounting accomplishes this objective is by translating economic events into 5 financial statements. A company's accounting information system identifies economic events of the company and analyzes the events to determine if they impact any financial statement elements. If so, then the event must be measured and recorded in the accounting information system. Once the company's economic events are analyzed, measured, and recorded, then financial statements can be prepared. Recall from the previous video that U.S. public companies are required to file their quarterly and annual financial statements with the Securities and Exchange Commission, or SEC for short, and that this financial information can be accessed via the SEC EDGAR website. I encourage you to look up the financial information of your favorite public company. The 5 primary financial statements highlight different aspects of performance that investors are likely to find useful. The balance sheet shows the company's assets, liabilities, and equity at a point in time. In the U.S., within each category, accounts are listed in order of liquidity. The income statement reports revenues, gains, expenses, and losses for a quarter or year. The statement of comprehensive income includes the income statement items and a few additional items referred to as other comprehensive income items, or OCI for short. OCI items that are reported on the statement of comprehensive income are closed at the end of the period to an equity account called Accumulated Other Comprehensive Income, or AOCI. This account is similar to retained earnings but relates to OCI items. The statement of retained earnings shows the increases or decreases in retained earnings for the period. In a typical year, net income will increase retained earnings and dividends declared will reduce retained earnings. The ending balance in retained earnings will also be reported in the equity section of the balance sheet. The statement of cash flow categorizes the sources and uses of cash generated for the period into 3 categories: cash from operations, cash from investing, and cash from financing. The sum of cash from operations, investing, and financing activities is the change in cash for the period. When this amount is added to beginning cash, the ending cash balance for the period is obtained. This amount is reported on the statement of cash flow and on the balance sheet as the ending balance in the cash account. Financial statements can be useful in informing numerous judgments and decisions made by investors. For example, suppose I am contemplating investing in a retail company. I have done a little investigating and I determined that the typical profit margin for retail clothing companies ranges from about 1 to 8%. Recall that profit margin is calculated based on information reported on the income statement. Specifically, profit margin is net income divided by sales. For example, if a company reported sales of $100, expenses of $80, and net income of $20, then profit margin would be 20%. The name of this potential investment company is Kate's Creations, and the income statement for 2018 is shown. Should I invest? Let's calculate profit margin. Net income of $51.75 million divided by sales of $623 million yields profit margin of 8.3%, an amount that is at the high end of what is typical for the industry. Because profit margin is a measure of profitability, a profit margin at the top end of the industry average is a signal of good performance. We could also examine other elements on the income statement to see if we can garner any additional information. Notice that Kate's Creations reports a $10 million impairment loss on PP&E. Impairments are typically considered indicators of poor performance. We have one good signal and one bad, making it difficult to know if we should invest in Kate's Creations. There are many next steps we could take. A common one might be to compare Kate's to a competitor. The fiscal year 2018 income statement for Nordstrom's is presented next to Kate's income statement. Because it is difficult to compare performance across companies of different size, we could calculate a few ratios to facilitate comparison. A common approach is to scale the items on the income statement by sales so that we can observe not only the actual dollar amounts, but also how large the amounts are relative to sales. Kate's Creation gross profit margin of 37.1% exceeds Nordstrom's gross profit margin of 36%, and the selling, general, and administrative costs of Kate's Creations reflects only about 24% of sales, whereas these costs are nearly 31% of sales for Nordstrom's. Tax expense as a percentage of sales is larger for Kate's than for Nordstrom's, but Kate's profit margin of 8.3% is a lot higher than Nordstrom's 3.6%. Should we invest in Kate's Creations? Based on an analysis of 2018 income statement performance, we would invest in Kate's Creations, particularly if we expected this performance to continue or even improve in the future. The important item to remember is that financial statements prepared in accordance with GAAP provide investors with information on companies' performance and risk to inform their investment decisions.